All right, so it is 9:31. I'm going to kind of jump in right now and get going. My name, I think you all know, is Mitch Frumkin. I will tell you that there was a bio of me at the beginning of the presentation. It's all the way at the end now. So when you get a copy of the presentation, you'll have my bio if you want to know it. I'll just give you a brief overview of myself. I've been involved with the Community Associations Institute for many, many, many years. Up until a year ago, this July 1st, I was the owner and operator of Kipcon, the engineering firm which I started, created, and guided towards July 1st of last year, at which point my son took over. So my son runs the firm, and I was actually in a webinar or something the other day, and I said, up until July 1st of last year, I spent 75% of my time on CAI and 25% of my time on the business. Nowadays, I spend 100% of my time on CAI and no time on the business. So my life hasn't really changed that much, although I do get involved in certain projects and certain things with Kipcon as the founder of the firm. From the trade or the organizational perspective in terms of the industry, I've been involved in CAI for many, many, many years. I was the president of the New Jersey chapter. I was president of the Pennsylvania chapter. I was national president a few years ago, and I've also been president of the Foundation for Community Association Research. So I've spent a lot of time at CAI. When it comes to what we're talking about today, and I'm going to show you actually a slide having to do with this when I get into it, but I'll tell you also that when CAI first developed the reserve study standards, I guess goes back about 20 years now, which is hard to believe, myself and three other gentlemen, Robert Nordland, Robert from California, Peter Miller from Maryland, and Bob Browning from California co-chaired the committee that developed the National Reserve Study Standards. And we also developed the reserve specialist designation. At that time, we drew straws to see who was going to get the RS numbers. I ended up with RS number 3. I think, if I'm not mistaken, Robert Nordland got number 1, but we worked on that together and developed the whole thing. It took a few years. A number of years later, oh, Jody is here. Your son said you weren't showing up, or Chelsea said you weren't showing up. A number of years later, when you introduce any type of standards, there's some clarifications and things that need to be done to make it more usable to the industry. So at that time, CAI asked the same four of us to chair a national task force to work with all the reserve specialists across the country. At that time, I think there were a couple of hundred of them, to get input to clarify the standards and update them. So the standards were updated again, when they're updated for the first time, I guess about 10 years ago. About 3 or 4 years ago, it's hard to believe it's that long at this point. You're all familiar with the collapse of Champlain Towers in Surfside, Florida. It changed our industry dramatically, as you all know. When that happened, CAI immediately put together a national task force to develop what's called the Public Policy on Condominium Safety. They asked me to co-chair that committee, which I did. I think I was the only PE structural engineer on that committee as one of the chairs. I think it was only one of the only engineers as a co-chair. And we worked with about 600 people from across the country and developed what are known as the Public Policy on Condominium Safety by CAI. When we put together that public policy, it became pretty obvious to us right away that building safety is not just based on doing inspections of the buildings to make sure that they're structurally sound, but also there needs to be a connection to two things: reserves as well as preventive maintenance. One of the things that scared me way in the beginning is that when you would read the newspaper articles, they would say the reason for the collapse was because they weren't setting aside adequate reserves, which really was not the case. It had to do with maintenance and other things. So CAI immediately then said, let's update the National Reserve Study standards to reflect not only reserves, but structural integrity and preventive maintenance, which we did. I was one of the co-chairs of that. And the new standards were issued about a year and a half ago. To reflect all of that, which I'm going to refer to that as I'm going through the presentation today. At the same time, CAI recognized that unless you have some kind of maintenance, reserves are going to cost you a lot more money, which I'm going to talk about, life cycle costs and things like that. But maintenance was hugely important for communities, not only from a safety perspective, but also from a life cycle cost perspective. So they asked me, I think it was Stephen Brumfield from Toll Brothers and 2 other people, to get together, and we developed a best practices report on maintenance, which I'm going to refer to. I think it's referred to in the title of this presentation, but I'm also going to refer to it as part of this presentation. the connections between it. So you can see I've been pretty involved in this stuff. I think if I'm not mistaken, the majority of everybody here, see, 120 people signed up, 63 are here, so it's better than usual, more than 50%. So, but when New Jersey looked at putting together legislation having to do with this, the charge was led by Senator Singleton in New Jersey. Senator Singleton approached CAI, the New Jersey chapter, for help in putting together the legislation. The legislation was worked on by myself, Dave Ramsey, an attorney, and Ed San George, head of Integra Management. And the three of us worked on behalf of CAI, New Jersey's chapter, to put together the legislation, which we're going to touch on today. The legislation very much mimics exactly, and I'll tell you where it doesn't, the National Reserve Study standards, as well as the public policy having to do with condominium safety. Very, very close, but that's why I reached out to us. So a lot of that is a direct connection to those CAI. When I look at this, I say if CAI didn't put together the public policy on condominium safety, I don't know what would be happening across the industry. I was also approached, just to get an idea, in Delaware, Newcastle County. They wanted to put together legislation on structural safety. So they approached me, and I actually co-chair that committee in Delaware, where they now have legislation in regards to structural safety, and they're in the process of updating their statewide reserve study requirements. If you look at the CAI website, caionline.org, you'll see in there's a place there. It has a map of the United States, and it has every state in the country that either has reserve study standards, or is in the process of putting them together. For example, if I'm not mistaken, somebody here is from Illinois, and if I'm not mistaken, you guys just voted on and they approved the reserve study regulations where it's in the process. So it's going on all across the country. And I hate to say it, but sometimes great things come out of tragedies. And a lot of these things I'm talking about would never have happened if it wasn't for the tragedy of Champlain Towers. I mean, it's totally changed the industry. So what I'm going to be talking about today, and oh, look, Kevin's here. Kevin comes to every one of my webinars. We're even wearing the same shirt, it looks like. But what I'm going to be talking about today is the best practices report on maintenance, and what do the changes in the New Jersey Reserve Study legislation say? Now, and this does relate to other states also, because in New Jersey, we put together the Reserve Study legislation as part of the bill that was passed last January 8th, 2024. But as that's been going through and becoming has become reality, a lot of things have come back in terms of questions about it, clarifications that are needed. So just recently, we worked on an amendment to that bill specifically dealing with reserves. About 2 weeks ago, it was put up for a vote in the state of New Jersey by the Senate and the Assembly, and they passed it unanimously. It's now sitting on the governor's desk for signature. If I'm not mistaken, the governor has 45 days to sign it into law, which maybe I shouldn't jinx it, but I don't see how it can't happen, especially since the Senate and the Assembly voted unanimously to move it forward. I'm going to touch on that specifically and how it relates to what we're talking about, and I'll tell you the reasons behind it. So that's where we are. That's what the presentation is. I will ask that if anybody has any questions, please drop them in the chat box as I'm going along. I think Chelsea's going to be monitoring the chat box, and she's not shy about interrupting me, and I'm not shy about saying I'm going to get to that in a few minutes, so I'm not going to answer it now. But if you have any questions, please drop it in there. I will tell you, I gave a webinar, or I was involved in a webinar similar to this just last Friday. There were a huge amount of questions. Usually my presentations are about 50 or 60 slides. Today's presentation is 36 slides only. But I'm sure there are going to be a lot of questions, and please do not be shy about asking questions about this because there's a lot of information, and you'll see one of my beginning slides is I'm really going to go into the weeds on this thing. This is more than an introductory course on reserve studies, and I'm assuming everybody here has knowledge of what I'm talking about. But if you do have any questions, please jump in and do not be shy. And Chelsea, I see there's 6 things in the chat, but I'm not going to look. I'm going to leave it to you.
You're good. Yeah, those are all.
Yeah, so I'm going to share my screen now and see if I can get this to work. And just tell me. And again, if you also, in addition to the chat box, if you want to just jump in and talk rather than just just, put it in the chat box. That's up to you also. So I'm going to swap presenter. So you guys should see the full slide. Does everybody see it?
Yes.
Okay. So I want to get this out of the way. I got something on my screen that's blocking my, I don't know how to move it. But all right. So again, I'm talking best practice report. What did the changes in New Jersey Reserve Study legislation say? Now, let's see if this move works. All right. That's what we're talking about. Again, I mentioned understanding the changes, the connection between reserves and maintenance, and how does this reduce your life cycle costs. I'm going to talk a lot about the connection between maintenance, reserves, and costs, because everybody's always afraid of costs, and you really need to understand the advantages of preventive maintenance in terms of costs, even if it costs you a little money to do it now. So that's what I'm going to be talking about. And our goal, and I think everybody's goal here, and I will say, if anybody here is not a community manager or a board member, if you wouldn't mind just dropping it in the chat box so I know who's in the audience, and if there's anybody other than that in the audience, so I can gear. I know Ben Lambert's here, who's an attorney. So, but if there's any other people out here, please let me know so I can kind of gear it a little if I have to. But the goal of everybody is for our communities is to maximize our property values, to minimize our life cycle costs, and at the same time to have structural safety in our community. That's what I think the goal of everybody involved in community associations is. Again, I am going to go into the weeds on this thing. A lot of information, but I'm going to be throwing out some numbers and showing you some stuff. Like I said, it's not meant to be a beginner's class. Again, this talks about what I said before. We started out with the Condominium Safety Public Policy Report, which led directly to the reserve study standards and the maintenance best practices. And Chelsea, if I'm not mistaken, we're going to send copies of all of these things to all the participants.
Yes, definitely.
So we're going to be sending you copies of all these. There's other information in regards to this on the CAI National Reserve website, but these are the ones that directly relate to this presentation. These all led to the New Jersey Senate Bill number 2760, which was the structural integrity reserve study legislation that was passed last January 8th or 9th of 2024. And then I added this to this slide on the right-hand side. This is the amended bill that, like I said, was just approved the last couple of weeks in the state of New Jersey. So a couple of baseline things, I guess, to understand is what is maintenance? There's three types of maintenance, and a lot of people look at maintenance as only being one word, maintenance. But there's three types of maintenance. And I will also tell you, if you go back historically in New Jersey, as well as many other places, when people put together the budget, everybody's been using the word deferred maintenance in place of preventive maintenance. It's the wrong term. We did it, everybody did it, but deferred maintenance means you're not doing maintenance. It's the postponing of maintenance. Preventive maintenance is something that you do proactively to maintain things so they get a longer useful life. You don't have what corrective maintenance is, which I'll talk about in a second, but preventive maintenance is proactive. Is maintenance. It's not deferred. They're totally different things. The third type of maintenance is corrective maintenance. Corrective maintenance is when you have to fix something once you find there's a problem. A lot of times you have to do corrective maintenance because you were not doing preventive maintenance, but there's no question that as buildings get older, you may need to do corrective maintenance even though it's something that you couldn't plan for it happening. But corrective maintenance costs a lot more than the cumulative cost of preventive maintenance, which is talk about why preventive maintenance is very important. And I'm also going to show you, if you don't do any maintenance, how that impacts you. Now, this is a slide that I really like. This is what happens if you don't do corrective maintenance, if you don't maintain something. This is the structure. It's a reinforced concrete column. And this is somebody looking at it because you didn't do any preventive maintenance. So you have to do a corrective maintenance, which costs a lot of money. By the way, I'm a huge proponent of AI. I use it all the time. I put in the words about this in AI, and I said, give me a diagram that reflects corrective maintenance when it comes to structure. This is what it came up with. The only thing it doesn't have is my face, but it's pretty amazing. So now let's talk a little bit about what the standards are when they come to maintenance. And I'm going to point out to you also the difference between what the National Reserve Study standards say in regard to maintenance versus what the legislation in New Jersey says about maintenance. And there's a critical difference between the two, even though the New Jersey legislation is based on it. But first, the standards. What does the CAI Reserve Study Standards say that did not say it before until it was recently updated? It says that reserve studies should incorporate supplemental reports that will minimize the life cycle costs of a community, improving safety of the structural system in the community. Those two supplementary reports are a structural integrity report, if you need one, as well as a preventive maintenance schedule, which everyone needs. Now, I've given webinars on structural integrity, and I'm happy to do it at some other time, but I'm not going there today. That's a whole presentation. But those are the supplementary reports that are listed within the National Reserve Study Standards. It says a preventive maintenance manual is recommended for all associations, although not a requirement for inclusion in the reserve study. Disclosures are required regarding whether a preventive maintenance schedule is in place and being used. Critical to understand, because what the standards say is, the national standards, that when somebody is doing a reserve study, they need to talk to the association to see if they do preventive maintenance. It's a yes/no question, essentially. If they don't do preventive maintenance, the estimated remaining useful lives of the components on the reserve study should be adjusted downwards to reflect the fact that they're not doing preventive maintenance. This is a key difference between what the standards say and what the New Jersey regulations say, which are this. There's two types of preventive maintenance legislative requirements in the law. One is for associations and one is for developers. I'm starting with what it says for associations, which means everybody in this audience, I assume, is related in some way or another to an association, and you're doing a reserve study. If you haven't done it by now, you're late, because the legislation said it had to be done within a year of the legislation last year. Not to go off tangent for a second, unless your reserve study was less than 5 years old, then it had to be updated within a 5-year period. But if you didn't have a reserve study, or if your reserve study is more than 5 years old, it needed to be updated to reflect the legislation within a year. The year is up. But it says that the reserve study should be prepared by somebody who's a reserve specialist, who's credentialed through the CAI, or an engineer or architect who is licensed in the state. So your reserve study does not have to be done by an RS, but it has to be done by either an RS, an architect, or an engineer who's licensed. And even if they're not an RS, it still has to be done in conformance with the national standards or some other standard, which none others exist. But keep in mind, it says, and shall include but not limited to the following. The only one I've highlighted here is, because the other things we can go over if you want, the anticipated costs associated with building maintenance has to be included. Now, keep in mind, the CAI standards say you have to recognize whether or not they do it. The New Jersey legislation says you have to include the cost. Big difference. You have to include the cost for maintenance. Now, when I say the cost for maintenance, I'll get into that in a few minutes, what that really means, but it has to be in the reserve study, as well as the anticipated costs of repair, replacement of common areas, which is a typical reserve study, which are necessary to maintain the structural integrity of the building. So also, when you do a structural integrity report, the requirement is that if there's anything that needs to be fixed right away, corrective maintenance, that needs to be included in the structural integrity report, along with when it needs to be done and the approximate cost. The legislation says that if you have a structural integrity report done, anything that's in that report that requires corrective maintenance has to be added into your reserve study. Now, keep in mind, not all associations have to do structural integrity inspections. I'm not going to go there, but if your building requires a structural integrity report and you're updating the reserve study, there's a timing issue. The structural integrity inspection should be done first, because anything that's found in there that requires corrective maintenance has to be included in the reserve study. So the structural has to be tied directly into the reserve study. But this is what it says for associations. You need to include the cost associated with building maintenance. Now, it's a little confusing, because it talks about building maintenance. There's maintenance related to the site in your community also, for example, roadways and retaining walls and all this kind of stuff. The legislation says building. I, as somebody who was very involved in preparing it, but not writing it because the legislators did it in their language, interpret that to really mean all common elements should have maintenance attached to it, but that's the words. Now, keep in mind, it also says a costs associated with it. It doesn't say you need to include in your reserve study a preventive maintenance schedule, which I'm going to talk about. Remember, it just says costs. Now, here's the big difference for a developer. When a developer creates a new community in New Jersey now, it used to be that the requirements were that they had to include a reserve study, which is still there, and fund that reserve study until the association takes over as part of the turnover, as part of transition. Now, in addition to the reserve study, the developer has to include preventive maintenance tasks over the life of the common areas, including scheduling and timing. So the developers now have to include a preventive maintenance schedule that lists what the preventive maintenance is, what it should be done to, what the timing should be, and how much it should cost. So it goes into more detail in the rest of this blurb here, but the developer, and now the key difference between developer and association, developer has to do a complete maintenance schedule, which I'll show you what it looks like. An association only has to include the cost of preventive maintenance. So how do you get to the cost of maintenance without doing a preventive maintenance schedule? I'll touch on that, but I just want you to see that it's just the cost that it says. It does not say a schedule. All right, now let's talk about the money. This is the advantage. I'm going to give you a bunch of stuff that shows the advantages of preventive maintenance. This chart, this graph talks about the health of your assets. Will they attain their useful lives? Now, the green curve represents preventive maintenance, and the red line reflects the life of an asset if you don't do preventive maintenance. So here, the green line, if you're doing preventive maintenance, your road is going to last this long. If you don't do preventive maintenance, it's going to need repairs and replacement this much sooner. So how does that reflect to your cost? An example, you have something that has a $100,000 replacement cost. It has a 20-year useful life, which is, or I'm going to go with it as a 30-year useful life, which brings you out to here. I think you can see my pointer. So it's costing you $3,333 a year over those 30 years. But now let's say you don't maintain it. It only has a 20-year life. How much is it going to cost you? Instead of $3,300 a year, it's going to cost you $5,000 a year. 100,000 divided by 20 is 5,000. 100,000 divided by 30 is 3333. The thing that makes it even worse in terms of the cost for the association, you're not doing any maintenance. Now you get to year 10 and you have somebody come out to do your reserve study and it says your roads are in such bad condition that you can't accumulate only 3,300 a year. You only have 8 years left before you have to replace it. So now you have to make up that difference in a much shorter period of time. So this $5,000 may become $10,000. But you understand the concept of preventive maintenance and how much it saves you. In many, many instances, by doing preventive maintenance, you can extend the useful life. Let's say this has a 30-year useful life based on industry standards or whatever, but because you're doing preventive maintenance, that useful life now can be extended out to 35 years or 40 years. Then you're setting aside even less a year. But that's one example of the value of preventive maintenance, the value and the cost of doing it, the reduction in cost of doing it. Now, just gives you a little graph that shows there's an optimal zone. For example, this orange line shows the need for corrective maintenance if you're not doing preventive maintenance. You can see as you're doing no preventive maintenance right here, there's a lot of corrective maintenance. Down here, you're doing a lot of preventive maintenance, so there's much less corrective maintenance. And then this blue line is showing the cost of preventive maintenance, which I'll show you can go up over time as buildings get older, but there's really an optimal zone in here to come up with a balance. All again relating directly to the cost benefits of preventive maintenance. Now, I'm going to show you a couple things. This is a typical reserve study, and this is a summary page, and you'll see why I'm pointing this out, because some of the stuff I'm talking about today, if you just go back to your reserve study, you can do a quick check of whether or not you're setting aside enough money for maintenance, and I'm going to show you how. But here's a summary of a reserve study. Now it says reserve requirement in present dollars. This is the total replacement cost of every component on your reserve study. So you add them all up. How much, if I were to replace every single thing in my reserve study, how much would it cost me today to do it? It's the total replacement cost of all components. In this case, it's $2,599,116. This comes from just an actual study I picked. But a very important number to figure out if you're spending enough money on maintenance. And I'll show you why in the next slide. But it's the total replacement cost of all components. I'm going to put an asterisk on that, which I'm going to talk about a little more later. It does not include the structure. The structure is not included in the reserve study. So when you're calculating based on certain things I'm going to tell you and amounts of preventive maintenance you should be doing, this does not include the structure, so it's going to be on the lower end. So, all right, so now you come up with the total replacement cost. Now here's a chart. And I've done a lot of research to come up with this chart for something I'm working on, but let's talk about money. Static components only. What I mean by this is you have a community, let's say it's a townhouse community, everybody has their own air conditioner, their own heating. So the common element charges do not include heating and cooling. Totally different from a high-rise building where that's generally included in your common area charges and the mechanical equipment is part of the common elements. When you go to something with mechanical equipment, what I'm going to talk about is much higher because the cost of maintaining mechanical equipment is much higher than the cost of maintaining static components, things that don't move, like roads, sidewalks, roofs, and those type of things. Now, on the left-hand side, you're going to see building age, 0 to 10 years, and 11 years or more. Really should be 10 years or more. So building age is related to the cost of maintenance. Now, the next thing is, see here it says baseline here. Baseline, baseline. What that baseline is, there are many, many references that I can provide because I've researched them all that say how much money should you be setting aside as a minimum for your preventive maintenance. In this case, for a community that's 0 to 10 years old, your baseline is setting aside 18% of your total replacement cost, which I showed you where it comes from before, 18% over 30 years. So if you take 18% of your total replacement reserve total, now you can see where I'm going into the weeds a little, 18% of that over 30 years, that comes out to 0.6% a year, meaning if you take your total replacement cost of all your components and multiply times 0.6 for a community that's 10 years or younger, that's a baseline of how much you should be setting aside in preventive maintenance each year. Now, if you go over to the next slide, a couple columns, what is the increase in life cycle costs? So your useful lives are being reduced, like I showed you, because you're not doing preventive maintenance. So how much can you anticipate your total cost over those 30-year period increasing if you don't do preventive maintenance? Obviously, if you're doing the baseline amount, the expected life cycle cost increase is 0. But now, if you're doing 0 to 10 years, you're doing no preventive maintenance, it's 0%, you can expect your life cycle cost, the total cost of all of your replacements, to increase, believe it or not, 25 to 30%. Now, I know I'm throwing at you a lot of information, but it's a concept that your costs go up significantly. Now, keep in mind that when I've calculated this for your increase in life cycle cost, these percentages have already included in them the cost of preventive maintenance. So it's net of the preventive maintenance. So baseline is 0.6%. It's not on top of the cost of preventive maintenance. It includes the cost of preventive maintenance. So it's the net increase you can see. So I'm going to show you an example. But now as associations get older, even if you do preventive maintenance, the cost of the life cycle cost increases go up. It's just, that's the way it goes. As things get older, they age quicker and preventive maintenance has more of an impact. So now let's take something that's 11 years or more. The baseline, instead of being 18%, is now 27% or 0.9% of how much your total replacement costs are. Now, if you have any questions, jump in, but this is kind of an important concept to understand. So if you do no preventive maintenance and your community is a static community, like I said, and you don't do no preventive maintenance, your increase in life cycle costs can be 35 to 40% more. Huge numbers. The other thing I show in here, just for reference, is if you're only doing 50% of maintenance, then it's halfway between. It's 9%. It's halfway between. It's actually a curve that it's not exactly half, but for basic budgeting like we're doing, I use that. But very important to understand that your life cycle costs go up over and above the cost of preventive maintenance. Okay, now let's look at an example. This is an association. It's more than 10 years old. I showed you a second ago that the baseline preventive maintenance cost is 0.9% of TRC. TRC is your C below. Oh, that was meant to be an asterisk, not a dot. It's meant to be total replacement cost, net preventive maintenance cost. So it's 0.9%. If no preventive maintenance, add 35%. So in this case, going back to what I showed you before, the total replacement cost is $2,599,116. Structure not included, like I mentioned before. So if you do no preventive maintenance over the life of that community, those 30 years, you're going to spend 35% more, or in this case, $900,000. Now, I know you're thinking this is the big numbers, huge value. Just think about the reduction in useful lives. And I'll tell you, if you take mechanical equipment and you don't do preventive maintenance on it, it's just, the standards generally say that mechanical equipment will lose 40% of its useful life. Huge numbers. So what do we do? Chelsea, no questions yet? Well,
There is a question, but I see that it's coming up with the presentation, so I'm going to wait to interrupt you then.
I didn't. Everybody's kind of shocked by these numbers. If I lost anybody, please jump in. All right. So now, what do? You start with a maintenance plan. For associations, you have a huge, beautiful starting point. It's your reserve study. What do? Number one, you create an asset list from your reserve study. Then identify which assets to include in the preventive maintenance program. It's in your reserve study except for the structure. I keep on saying that. 3, this is not in your reserve study. Identify preventive maintenance tasks, determine the frequency of the tasks and the approximate costs of the tasks, create a preventive maintenance plan, train your maintenance team. Now, some associations, depending on the complexity of them, may rely on their community manager to look around to see what the maintenance is, what's required or what's deteriorating. You have to be very careful because the person who's doing this really needs to have qualifications to do it in many cases. Also keep in mind that you can incorporate doing your inspections, which are a big part of preventive maintenance, as part of your reserve study. Again, going back to New Jersey legislation, you need to include a cost, but you don't necessarily need to include a plan. Where that goes back to, as one example, if you're including a cost in New Jersey without doing a plan, take an association that's 10 years old, does no preventive maintenance, then you should be adding, well, the baseline is they should be budgeting 0.6%. So if I'm doing a reserve study for this type of community, and the statutory requirement is that you need to include the maintenance cost, without doing a schedule, you could just say, okay, I'm going to take 0.6% in this situation, or 0.9%, whatever it is, and say that's the cost of preventive maintenance per year without doing a preventive maintenance schedule, which gets into more detail, I'll show you, but this is a guideline, industry guideline for coming up with a cost without doing a schedule. Because like I said, the legislation doesn't require a schedule for associations. Create the plan, pretty straightforward. What are you inspecting? How often are you inspecting? Train your team and monitor and adjust. The CAI National Reserve Study Standards suggest that every time you do a reserve study, you adjust your preventive maintenance plan as part of that. Either the person who did it or the reserve provider, if they have the qualifications to do it, update the preventive maintenance plan. I will tell you from an update perspective, the best practices across the country are to update your reserve study a maximum of every 3 years. The legislation in New Jersey says you can't wait more. You have to update it every 5 years. But in many cases, the reserve study you get from your reserve provider will say that you should update it in 3 years. Or if you're doing baseline funding, which I'll touch on in a second, and I think you all know kind of what it means, you may recommend that it be updated every year. And I'll touch on that in a second. But monitor and adjust, generally it's recommended you monitor and adjust your preventive maintenance plan at the same time you do the reserve study, because the number one part of a preventive maintenance plan is doing visual inspections to see the condition. It's not just a matter of painting a fence. It's a matter of looking at them also. So that's the maintenance plan. Now, you take a look at your reserve study. Here's your list of assets. In this case, it's the site work, but it lists all the assets, which are tasks 1 and 2. You identify the assets to include. Now, what do? Here's a table, just an example table that I put together that shows for each of the things that are identified under site here. You got a list of about 10 things. For every one of them, now I say, what is the component? What are the tasks? What is the frequency? And what is the approximate cost? So to do a thorough preventive maintenance plan for your community, if you start with the reserve study and do lists like this for every single component and what the task is, the frequency, and the approximate cost, that is a comprehensive preventive maintenance plan. Again, the developers, when they do their governing documents, need to do something like this. Associations just need to include the cost. So I know that at Kipcon, what's done is that if you do and Chelsea, tell me if I'm wrong, if you get a proposal from Kipcon to do a reserve study or an update, it will include in there a cost for preventive maintenance based on a percentage, but it will include the cost there to do a complete preventive maintenance schedule, which is much more comprehensive. So, but I've mentioned that a few times because there's a clear difference between the two. This is what a preventive maintenance plan looks like in a reserve study. Again, it includes every single things I talked about: the quantity, the cost, the requirement and cost, all that kind of stuff. But that is very similar to this. Now, I want to also tell you that accountants sometimes say that the preventive maintenance should not be included in the reserve study because of potential tax consequences. That's what they may say. And I don't know the 100% truth of that because I'm not going to try and be an accountant. I'll try and be a lawyer, but not an accountant. But that's what they say. So the question is, why do you include preventive maintenance in the reserve study if there could be tax consequences? First of all, when we did the standards, we're doing these in terms of the common area components of the community from a technical perspective, not from accounting perspective, first of all. But what we've done, or what Kipcon does, if I'm not mistaken, is they don't mingle the two. So there's a reserve study, but in the reserve study, there's a separate page that looks like this, just for the preventive maintenance tasks, so they can be separated in case an accountant says, I want to separate these out from the reserve funding for tax consequences, but they still need to be included in the reserve study for legislative reasons. So here you could just subtract it out because although it's in the reserve study, it's a standalone part of the reserve study. Couple other things, very important, that's in the new standards, and it's also keep in mind that the legislation says the reserve study shall be prepared in conformance with the CAI standards. Another critical change that I want you to all be aware of, it used to be that the reserve studies were based on what you can see. There are many, many things that in a building, especially high rises, that are part of the common elements that you cannot see, such as plumbing pipes and all these type of things. The standards are now very specific. It says that in many cases, components may not be visually observable, yet should still be considered for inclusion in study based on the reserve schedule, the reserve provider. So when you're having somebody do a reserve study for you, they should also be including in there the cost for replacement of things that cannot be seen. There's another document that CAI put together. It's called infrastructure cost. And it talks about how many associations are getting hit with the cost to replace things that are not on the reserve study so that because they cannot be seen. But it's very important that unseen common elements should be included in the reserve study if they require replacement. So I put the questions on the bottom. How is it done? You can use a percentage of the total cost, or you can use just come up with an estimate. But I just want to be aware that this is what's required, that you can't see it. Now let's talk about the New Jersey legislative law. And this is very similar in other states that I've been involved in, why we've run into this problem. In New Jersey, it's the red line, I call it. Here's the red line right there. In New Jersey, for many, many, many years, when a developer prepares a governing documents for a community, they have to include in those governing documents a reserve schedule and funding for that reserve study. I'm not going to get, it says based on adequate funding. I'm not going to go there now, but that's what it says in the legislation in New Jersey. So developers, when they're developing a community, have always had to put in a reserve study and fund it. So what happens? They start with zero. As the community gets older until they turn it over, they're accumulating money. Then what happened? The associations are now in control. It's turnover. The community is now in control. Now I'm going to make a joke. Some of you will. So what happens when they turn over control? Part of the transition process, the association then sues the developer for underfunding the reserves, and then stops funding the reserves. So, but what happens is the community is now in charge of funding the reserves. There's no legislation that's been in place requiring associations to prepare reserve studies or fund them, even though the developers have. So what's happened, rather than the association continuing to follow this nice gray line, accumulating funds and never going into a deficit, associations have not been funding adequately. So they follow this yellow line, and it comes as they get older and they need to replace something, they don't have enough money. That's the problem we've gotten into in New Jersey. So when people say that the legislation has caused a big bump in our reserve funding requirements, it's not the legislation. It's the association for not funding properly that has caused this to happen. But that's what's happened. So what has the reaction been to associations in terms of this legislation? The associations have come back to the legislators and said, there's been jumps in my funding, big jumps in my funding. They've said we need a clarification of the definition of adequacy. What does it mean to be adequately funded? I will tell you the original legislation does include a definition of adequacy, but it's kind of hidden in there a little, so people weren't really sure what it meant. The other thing is the providers, the people who were doing the reserve studies, were not including in their study a funding model based on adequacy in their funding models. So this is what this legislation has tried to address. How do we clarify these things? But the cause is, like I said before, associations not funding properly. So what does it now say? It includes in the new legislation a definition. Let me see, how am I doing on time here? Chelsea, how am I doing? Am I okay?
2 minutes left.
10:15. All right. Definition includes a definition of adequacy. The definition of adequacy is very simple. If you take a funding plan and over the 30-year funding plan, and it's required to have a 30-year funding plan, if it drops below zero, you're not adequately funded. End of story. That's what the definition is. I also included in here the definition of baseline funding for the national standards. It's the same thing. Baseline funding means, according to the standards, you can go down to zero and without getting money from anywhere else. Keep in mind, it doesn't say in the standards that that is adequate. It just says that's the minimum you should ever go, because depending on the associations and many different other variables, that still may not be adequate for you. And that's one of the reasons that reserve providers that I've seen have not included a baseline funding or adequacy funding model in some of their studies. I will tell you, I've seen them all, because what happens is associations go back to the legislators, say there's a problem. The legislators then point them to me, Dave, and Ed and say, would you mind talking to them to try to understand what the problem is? Then Dave and Ed a lot of times look at me and say, Mitch, you're the engineer and the reserve provider. Let's take a look at the study. 99% of the time, it's because the associations have not funded adequately in the past, and because the people putting together the studies would not include a way for them to get to where they are to adequate funding in an easy way. I've seen them all, and they're all like that. So what does the legislation do? It defines adequacy. Now it says that the legislation says the study must include a funding plan that goes down to zero. It doesn't mean the association has to use it, but it must include one so the community can see the lowest they can go and still meet the definition of adequacy per the legislation. The other thing that I would see a lot of, or a lot of every one of them, is somebody will update the study. The association is putting aside $50,000 a year. The study says you need to put together $100,000 a year to get to adequacy. No association can jump and double their reserve funding each year instantly. It could have been done before based on legislation, but nobody was doing it. So now it very specifically says that the study can include escalating annual contributions as long as it doesn't go below zero. So if you're setting aside 50, you need to get to 100. You can go 50 year one, 55 year two, 60 year three, and gradually get to where you need to go as long as you don't go below zero at any point during those 30 years. So this is what it looks like. The green line here is adequate funding or baseline funding, because you see it drops down to zero. The red line is what the association has right now. They're going into a deficit, but this green line now has to be included in addition to other funding models, such as what's shown here. If they want threshold funding, full funding, I'm not going to go into differences between them, but you can see that they're higher. But the legislation now requires that this baseline funding or adequate funding has to be included. What else does it say? All right, it says it must include adequacy. The study can include escalating, I talked about, but I wanted to go to the next slide. Actually, I talked about that. It also, this is new, very new, because of the pushback. It says that it allows associations to fund at 85% of their funding plan for a maximum of 5 years. So let's go to an example. I'm going to jump ahead for a second. This association, see the red line? This association was at baseline funding. Everything came down to zero. At this point, it came down to zero here. But now it says they can go down to 85%. As soon as they go down to 85%, there's a deficit. It's going to go below zero. There it is right there, and there it is right there. So what the legislation says is that if you do use this 85% model and you go below zero during that, because of it, that the association needs to disclose to all the unit owners and provide a year in which a special assessment or loan is anticipated as a result of the reduced funding of the reserve fund and the amount of the anticipated assessment. So let's say you go to 85% and it shows in that low point where we go to zero that there's going to be a $100,000 deficit. You're going to need a special assessment. It needs to disclose that they're doing the 85%, that there's going to be a deficit and a special assessments required, the year it's required, and how much it's going to be. It also says that if somebody wants to buy a unit within that community, it also has to be disclosed. So keep in mind that the 85% rule, I guess, sounds good to people, but it's got to be disclosed, and it's only good for 5 years, meaning that at the end of 5 years, you have to go back to adequate funding. You can't use the 85% rule anymore. And that means you take that 15% a year that you have not been funding and you have to catch up to it. So you're actually pushing the can down the road in order to get you to some type of funding without a huge jump. Also, I'm really going to go into the weeds in a second for this one. If your association is only funding it is much lower than this 85%, you still can only go to 85% of adequacy where it goes down to zero. So it may take you 30% increase to get to adequacy. So you can drop it 15%. So you still have a jump of 15%. So, and that really went into the weeds, but so this 85% is nice. It's not the best. It pushes can down the road a little, but at the same time, it still may require an increase. Now, this is from an actual association. Very interesting. The association is 39 years old. They had a study done 5 years ago. It recommends an annual contribution of $155,000. All right. What did I say before? They're not funding it where the reserve studies show it. Their actual contributions were only $85,000 a year. So they were funding $70,000 less a year than their studies showed. 70 grand. So it's not adequate. So the maximum deficit in the year 2040, right here somewhere, is $353,000. Now, this is just coincidence. I didn't make up the numbers here at all. But if the association had set aside during those 5 years that weren't setting aside the money, the full amount the study said, it would have been 5 years of $70,000 a year that they weren't set aside, which comes to $350,000, 350, which would have wiped out this deficit and they would have been adequately funded. It's just an example of what can happen if you don't fund what the study shows. In this case, and I'm telling you the truth, I couldn't believe that it came out to exactly what the deficit was. I just picked this out of one of the studies that we had done. All right, getting to adequacy, current contributions, 85,000. Here's another example. Getting to baseline, you have to have an increase. You have to jump to $108,576 a year. So that's what you have to jump to. But you don't want to jump because it's a 28% increase. You can't do it. So I'm just going to give you an example of how you can increase it slightly each year without a jump from 85 to 108. Again, down here, I just said if you went to 85%, it would be 92, but I'm not going to go there. I talked about that. So this is what it looks like. Now, here's the chart where I really get into the numbers. These are the numbers behind the reserve study. Here's the current funding. Here's the years. Here's a baseline funding or adequate funding. So what this is showing is the association is setting aside $85,000 a year every year. That's what they're doing. By doing that, they run into deficits. Here's what the deficits are, these red numbers. If they go to $108,576 a year, they get to adequacy because the lowest it drops is to zero. So this is what they have a big jump. So what can they do in place of that? They can do an escalated annual contribution, and I'm going to jump right to the numbers. Here, they're starting at 85, but instead of jumping from 85 to the 108 or whatever I said, they increase by 3% a year. They go from 85 to 90 to 92 to 95, and they're increasing it by 3% a year, and they're getting to adequacy. It's $31. I didn't get it to exact zero, but they're getting to $0 here. But instead of having a jump immediately, they're doing it gradually and still not going below zero. It takes a little longer to get there, but it's a much more gradual increase to get there. And then you see what happens? After they get there, they stop increasing by 3%. It's a 0% increase, and they're still above adequacy. And this is what the graph looks like. Very similar. This is where they were. Now you do a gradual increase, and you get to this line, the brown line, by increasing 3% a year for 14 years. This is what you should be looking at. There's a number of different things if you're underfunded. The other thing you have to keep in mind that this study also says probably in year 3, right here, you're going to need to update your study. Maximum of year 5, but you're going to need to update your study. But this is what it specifically says in the legislation now, that you can go escalated annual contribution increases as you're going along to get to adequate funding. Now let's see, current contributions. All right, but then it says you also can put in other funding plans. So in this case, I just wanted to show you that here, if you do 3% a year, you get to zero. But some people say, well, that's not enough. Going to zero is too risky because if something costs $10 more, I'm going to run into deficit. Or if it has to replace a year earlier, I'm going to run into a deficit. I don't want to do that. I want to be a little more conservative, which is what the CAI reserve study standards recommend. So instead of doing 3% a year, I'm going to increase it by 5% a year. If I increase by 5% a year instead of 3, you have a low point here or a threshold of $260,000 rather than zero. But it shows even by doing gradual increases of 5%, you can fund it and still be much more than adequately funded based on the legislation. So now, what was our goal? Maximize property values, minimize life cycle costs, and structural integrity. So I think I am now going to stop the share, and I hope that most of you hung in there with me what I was saying, because I really went into the weeds on this one. But I just want to show you that a lot of people, when they do reserve studies, I hate to say it, they have software. They plug in the numbers and they take the answers. And they don't say to the community, how do I get you there? Oh, Stephanie Harmon is here. What an honor. But they don't, they want to jump without looking at ways to get there gradually based on what the legislation allows you to do. So I will tell you also, if you ever have a study, whether Kipcon did it or not, and you want me to take a quick look at it based on what you got, to make recommendations on how to get you to adequacy without a big jump based on what the legislation is, just send it to me. So, then I see one question. Is there any way that the state actually monitoring this? From the structural integrity perspective, those reports have to be given to the municipal building official. From a reserve study perspective, there is nobody, DCA is not monitoring this. This is, when I say self-monitoring, a couple things are going on. If you, Fannie Mae and Freddie Mac have certain reserve study requirements, certain requirements in order for lending for refinances or new purchases. Right now, if I'm not mistaken, about 75 to 80% of refis and associations fall under Fannie and Freddie. Fannie and Freddie say that you have to set aside either a minimum of 10% of last year's association budget or meet the statutory requirements if there are any. That's a big thing that's going to enforce this. The other thing is, I'm anticipating that there's probably going to be some kind of lawsuit that's going to happen where somebody's going to move into a community. There's a special assessment because the association has not been adequately funded. And I don't mean to surprise you and let you know that we're kind of in a little bit of a litigious industry where they're going to go after the board or the realtor or somebody and say, you didn't notify us that or you're not meeting the state requirements for reserve funding. But it's self-enforcing. The state is not monitoring it. So that's not an uncommon question. Anything else?
Yes.
And feel free to jump
Several
in.
questions.
I'm sorry. Go ahead, Chelsea.
Just going to go through the questions that are in here. The bill was written to broadly include all planned real estate, community associations. Our local senators were looking to amend this to exclude us as a private lake HOA community, no high rises, condos, etc. Basically, do the recent changes address this at all?
No, any community that is a residential community association in the state of New Jersey falls under this. That's all there is to it. The only exclusion you can have is that if your common area assets have a value of $25,000 or less, then you don't have to do this, but I don't think there's many of them.
And then we have two inflation questions. One, how is inflation factored into the calculations? And then besides inflation, how are investment returns factored in?
All right. Great question. The old interest inflation question. Statutory requirements do not require interest inflation. Back in the day, before the legislation, associations sometimes would say, I'm going to include 2% interest, 2% inflation. And generally that was, well, they would do that. And a lot of times it was done because they weren't going to update it. They felt that interest and inflation would offset each other and they'd keep up. First of all, interest is only on the money you've gained. Inflation is on the total replacement cost. They do not offset each other. Second of all, I've seen a number of times, as soon as you start adding inflationary costs to the replacement cost, you're guessing on what it is. And some people, because there's high inflation right now, may get 8% or 9%, whatever. And it just blows the whole study out of the water. It makes the funding much higher than it should be. I don't think you should include interest and inflation for a couple of reasons. First of all, when you update your study, a maximum of every 5 years, the starting beginning balance includes any interest you've earned, and the replacement costs include any inflation that has occurred since the last time the study was done. I did a side-by-side spreadsheet of updating them and taking into account interest inflation when the study's updated versus including it and projecting it out the full 30 years. And the total conclusion at the end is pretty much similar. All I know is that if you include inflationary costs in the study, it's going to jump up your estimated annual contributions big time. And I don't think you need to do it. I would just make sure include when you do the study, it takes that into account. But I see another, and Chelsea, anything else? Feel free to unmute yourself and jump in verbally if you like. Use your. All right. Let's see.
Right.
Yeah, the Structural Integrity Act was designed to protect the structural integrity of condominiums and corporate buildings. But
That's the one we went over.
Okay.
I see, I did not see roofs listed in your slides. Please address preventive maintenance for roofs.
Great question. Well, preventive maintenance is, like I said, a big part of it is visual observations. If you have, for example, we're talking about a shingle roof. If you have a shingle roof and you walk around and shingles are lifted and those type of things, you have a leak. I mean, obviously you need to do something. But a shingle roof is really just looking at it and seeing if there's any deterioration of the roof and taking care of it. Flat roofs are different. We've gotten involved in it. You can look at the seams in the roof to see if any of the seams are coming apart. But a lot of this stuff is based on visual observations and then fixing it so it doesn't get worse. If you have a flat roof with insulation underneath it and one of the seams comes apart and water starts getting underneath it, if you fix it now, you may have a very small area that you have a problem in. If you let the water continue getting into that, the whole roof is going to be destroyed.
Has there been any change to the 10-year catch-up period for overall increases over 10%?
Good question. The 10% increase is something that has been misunderstood from day one. That increase is based on if you continued when the legislation was passed to use an old study and you had not been funding it, that's where that 10% requirement would fall into place. It's 10%, more than 10%, 2 years, or I mean, more than 10%, 2 years, less than 10 years, or whatever it is. If you're doing a new study, it doesn't come into play at all. And what you're doing in a new study, you're actually amortizing any underfunding over the full 30-year projection for the period, and you do not have to use that 10-year catch-up period. I would kind of, and don't tell anybody I said this, kind of, don't worry about that 10% catch-up period. It's superfluous to the bill. As long as you're not going below zero, you're fine. And if you're doing a new study or updating an old study, it really doesn't even pertain.
Are there any limitations or penalties if the association has been severely underfunded and trying to increase to catch up aggressively?
Well, like I said, there's no statutory, nobody's chasing you down. But I think that, you connect, the penalty is life cycle cost reductions and all these kind of things. But the penalty is going to be when a roof needs to be replaced, it doesn't care if you have enough money in your fund or not. You're still going to need to replace it. If you have the money accumulated, what you're doing is the people that live under the roof have been paying for it. And just think about it. You don't fund for the roof. Somebody's been living there for 19 years. They move out. They never funded for the roof. Somebody now moves in, and in year one, the roof needs to be replaced. There's a special assessment. That new homeowner is paying for a roof that they never lived under. So there's a lot of different variables here, but the bottom line is that ongoing funding is the way to do it. The penalty is special assessments.
And Dean said, we have an association that read the repair or replacement as meaning legally all items can be repaired as opposed to replaced. One association interpreted this to mean we don't have to budget for the roof replacement, just repairs. We don't agree with this perspective, but ...
Well, it's an interesting comment, but it does say repair or replace. That's what the national standards say also. The intent was for major repairs. For example, if you have a boiler and you need to replace or repair a motor or something like that. But the majority of common elements have a useful life and they will wear out even if you repair them on an ongoing basis. Because I kind of interpret sometimes repairing as very similar to preventive maintenance, the way I was just talking about roof shingles and that type of thing. But the intent is all these components have useful lives and they will need to be replaced. Also, keep in mind, the question came up the other day from somebody that, we have a dollar amount in there for maybe replacing sidewalks that's 30 years. We have sidewalks that need to be replaced now and the association is only 10 years old. I guess that means we can't take the money out of the reserves. This is a budgetary tool. Some of these things, if it says 30 years, some of these things will last 50, some of these things will last 10. But the money in the reserve study is intended to be used to replace them. But keep in mind also that as soon as you replace something, you should update it so that it amortizes the new stuff over the full useful life and may reduce the annual contributions you need to make. Is that it?
I think so.
All right, well, if anybody has any questions, feel free to email them to us. The other thing, like I mentioned, that if you did want me to take a quick look at what you've got going on, even if if Kipcon didn't do the reserve study, I'd be happy to take a look and make recommendations. I've looked at so many of them now because their legislators are getting comments. But when I say so many of them, for all the associations in New Jersey, the amount of people that have gone back to their legislatures is very small amount. And also, it's generally the older associations that weren't funding enough, and they need to increase it because their roof has to be replaced in 3 years, and they never accumulated the money to do it. So it's really, and the other thing is, once we go through this cycle of updating reserve studies, in a few years, this issue is going to totally go away because everybody's going to be funding properly. They're going to be funding adequately, and we won't have any jumps anymore, just the way it should have been done in the beginning. When the legislation was done for developers, it should have been done for associations at the same time. All right, thank you very much, everybody. Have a great day. And if you ever want any webinars or topics, just let Chelsea know. And Stephanie, haven't seen you in years. Take care, everybody. Have a great day.
Thank you.
Before everybody jumps off, real quick, I'm going to be sending you an email. Feel free to reply to that asking for your CEU certificate right there. So you'll have my email address right then. All right. Thank you, everybody.